Greetings, everyone, and welcome to our February 2024 quarterly macro and market update with our Chief Investment Officer, Michael Dow. I am Julien Frazeau, your Director of Risk Management and Securities Research here at Beacon Pointe, and it is my pleasure to be your macro and market moderator today. So we've got a lot to cover, but before we bring Michael in, just a couple of housekeeping items. We budgeted up to 90 minutes for this webinar, and we have more than 50 slides to cover. We also get a lot of great questions from our audience, and we want to make sure that we have as much time as possible to address as many questions as possible. So we might aggregate them, and we'll try to cover as many as possible. So if you have questions, please type them into the Q&A box at the bottom of the Zoom screen, and we will address your questions throughout the course of the presentation. Also, note that we are making a recording of this webinar available at beaconpointe.com/videos approximately 48 hours after the conclusion of today's live event. Okay, so what's on the agenda for today's call? In the first section, Michael will talk about the global growth outlook. In the next section, we will discuss the US economy, the election, inflation, and the Fed. In the third section, we will talk about cash and the illusion of safety. With money market saving accounts yielding 5%, it is tempting to stay in cash to protect capital from potential recession. The illusion lies in assuming that cash is risk-free. In reality, cash carries risk related to inflation, opportunity cost, and interest rate changes. And as usual, we will wrap up the webinar on how to position portfolios in the current environment. So without further ado, let's bring Michael in.
Julien, thanks very much for that introduction. When we begin these presentations, I always like to remind the group what it is that as investors we care most about. And that really boils down to where we are in the business cycle. Are we going to have a recession? Are we going to have a soft landing or a hard landing or a no landing? It matters what the Fed is doing, and the Fed is driven solely by inflation and inflation expectations data going forward. So what the Fed's doing, and frankly, corporate profits, are they resilient or not? So if you can get a handle on basically what the Fed cares about, and what the Fed cares about is simply the economy and inflation, and you can get a handle on corporate profits, these are the things that matter. There's a lot of things that are not on this list. And they are the most recent, newest investment idea, or in many cases, what I would say is, and I'm not denigrating thematic investing because I think there's some to it in the long run, but short run thematic investing, meme stocks, politics aren't on this list either. So we're going to dig very deeply into the implications of the election, but just to start with a conclusion. The U.S. economy seems to be quite resilient. The labor market certainly is resilient. Economic growth is higher than expected. The unemployment rate is much lower than expected. And frankly, corporate profits are holding up very nicely. So contrary to what I would have said a year ago, which like a lot of economists, we were predicting an economic slowdown, if not an outright recession, I think there's some explanation for why we haven't got one. And I'm going to get into that right after we talk a little bit about again, the conclusion. We could talk all day about macroeconomics, but if we don't talk about asset allocation and how to position the portfolio, then we're really not accomplishing anything as it relates to trying to protect clients to the downside and frankly, make money for them on the upside. We're still in the late cycle of the business cycle, except this time it isn't as clear cut. And we started talking about this a couple of quarters ago where we didn't really know with a high degree of confidence where we were in the business cycle. We've been calling it late cycle for the last year and a half, but we keep bouncing back and forth from late cycle to more sort of mid or almost an expansion. And basically the way you can tell where you are in the business cycle is by identifying certain macroeconomic and market data and plotting it on the business cycle that looks like a sine wave. And historically, you've been able to just point right to a cluster of economic metrics that suggested you were either in the early, mid, late, or contraction phases of a business cycle. But things are now stretched out. There's the data points are all over. So it's very confusing where we are. And I'm going to talk a little bit more about that. But bottom line is, when you're in an uncertain economic environment, you want to stay close to home in terms of risk taking. And that doesn't mean taking zero risk. There is no such thing as a retirement account that takes zero risk. Cash is not an option. We're going to talk about the illusion of safety in cash, but cash is not a retirement asset. So you need to take risk, the exact amount of risk that's commensurate with your investment objective. And we quantify your investment objective here at Beacon Point as to be basically the market returns, the expected and actual market returns. We look forward at the expected returns, and then once we get 5 years out, we look backwards at the actual returns and compare the performance of the portfolio against both of those things and try to see if we're on track to achieve whatever investment objective it is that you've articulated to us. And in that context, we're not taking no risk. We're not neutral. When we say neutral risk or overall risk stance, doesn't mean we're not taking any risk. We're just taking the exact amount of risk by our state-of-the-art risk metrics that we use, that Julian monitors and leads as head of risk management. We're just taking the same amount of risk that's in effectively the market. And you want to be there because the uncertainty is so high. In terms of equity market risk, we're actually somewhat defensively positioned. And this has not been a great place to be. Overweight value, underweight growth, especially with recent developments in the last 6 or 9 months in AI, and up to and including NVIDIA's earnings report, recent earnings report, which has caused the stock to just blow up. We're going to talk a little bit about that. But in terms of equity market risk, we're slightly underweight, not tremendously. When I say we're underweight growth, it's a couple percent, and overweight value, a couple percent. That's it, versus the benchmark weightings. That's it. In terms of bond market risk, we do have a little additional interest rate risk. And our view there is that an increased duration in the portfolio is a great hedge if we ever do get a slowdown. So some of the positions that we have had on for the last year or so have been defensive. They have not outperformed the benchmark necessarily. Our manager selection has, but our asset allocation is not. So we're constantly monitoring where the portfolio should be. We're constantly adjusting it to reflect both market events and our outlook. And right now we remain neutral risk, which is not a bad. There's no vice in being neutral when the uncertainty levels are so high. The last point I want to make on this slide is simply, no matter where you are with your stock market allocations and your bond market allocations, having a strategic allocation to alternatives, which includes, private equity, private real estate, private credit, et cetera, having a strategic allocation, which is relatively unvarying, is going to add higher expected return premiums to the portfolio. That is, you should expect a higher total return in a portfolio that has alternatives, and frankly, lower volatility or lower risk. So adding alternatives to the portfolio is an excellent way to optimize it, and it's why alternatives are, our recommendation is to be 20 to 30% alternatives, depending on your liquidity needs. So when you have a late cycle, when you are where we are, the uncertainty level's high, just stay closer to home. Not no risk, just neutral risk. So let's talk about the global growth outlook just for a second. This is the chart we always present. It's got the global JP Morgan global PMIs, or purchasing manager indices. These PMIs are simply a summary measure of economic activity, both for services and manufacturing. The manufacturing index globally has been in a contraction phase that is below 50. It's a diffusion index, so anything below 50 is contraction. Anything above 50 is expansion. Global manufacturing has been in contraction for the last 18 months or so, but it's now peaking above, or is just at the expansion contraction line. But global services, which were heading lower, and this is part of why we thought we were headed for a slowdown here in the US, has not only recovered, but has rebounded very nicely. And on the right-hand chart, you can see, global growth is kind of greenish yellow after having peaked back in the spring of 2023. This is global growth. You've got developed, emerging, and then individual economies. The US is kind of middle of the road here, kind of neutrally. And we'll see a more detailed US map with a lot of different economic and market metrics that indicate that we're in this sort of a stretched out rolling recovery and rolling recession that we don't know exactly where we are. That's indicative of kind of yellow. It's not green, it's not red. and all the rest of the countries here that you care about are represented. It was a bit of a slowdown, particularly in the Eurozone, second half of last year. Anyway, the bottom line, we were seriously thinking that the global economic picture was deteriorating pretty rapidly heading into 2023. And after peaking in March and April, we thought we would see a slowdown, but now things seem to be recovering. It's a very unusual post-World War II recovery. A lot of what we're talking about as it relates to global growth has as its core the monetary policy that's being pursued around the world. We've already seen peak monetary policy now in terms of interest rates, it appears. So in terms of rate cuts and rate hikes, what we have here is the developed economies in the last 12 months have seen 99 rate hikes, 35 in the emerging markets, whereas the developed economies have only seen 2 rate cuts in the last year and none in the last 3 months. So clearly there's more hikes than cuts, except when you're looking at the emerging markets. We split it out, emerging and developed, because it gives us a little more information here. But in the emerging markets, rate cuts now seem to be dominating rate hikes. 14 rate cuts in the last 3 months versus 4 rate hikes in the emerging. The average rate that's being paid by global central banks that are classified as emerging economies is closer to 9%, whereas the global developed is closer to 3.8. I think what we're saying here is basically that you had a significant ramp up before developed markets got wind of the inflation environment, and emerging markets started tightening very meaningfully, and then the developed markets kind of followed along. Julian, is there a question?
Yeah, I was going to just preview the next section with a question that's on everyone's mind, which is, are we going to see a recession or not? Are we already in a recovery phase?
Let's dive into the U.S. after sort of taking a survey of the global situation. The U.S. doesn't operate an economy in a vacuum, so it's always nice to have a little bit of a sense of where global economies are headed. This is just the economic review. It's data we've seen lately. Basically, this is the GDP number for fourth quarter. Very strong 3.3 after a blowout or a blockbuster, nearly 5% GDP. The composition of GDP is here. I would have said back in September that given the amount of inventory increases that we saw in the third quarter, which contributed mightily to the nearly 5% GDP print, that you'd see a slowdown, that things would start to tail off. And in fact, blue chip economists feel that the forecast for GDP for all of 2024 is somewhere on the order of 1%, which doesn't sound like a recession to me. We're getting pretty close by the time we hit the second quarter. But again, the same economists were predicting a recession back here in 2023. So it's confounding all of us who spend a lot of time in the last 25 years looking at macroeconomic data and doing the associated business cycle analysis. It's been a puzzle, frankly, to try to identify what's happening in this economy and why it's different. But it is different. It's most assuredly different. And here's what I was mentioning earlier in terms of where we are in the business cycle. Normally, I would put the economic growth line here because this is where all the data suggests we are. Sentiment, which is recovering, and labor markets, which seem to be at some point weakening, but more recent labor market data looks a little stronger. The public market financial conditions indices, which basically predict future economic growth, are easier with higher equity prices and lower interest rates or lower interest rate spreads and stable interest rates for the most part. But it's hard to tell. Normally, this is what I was saying, normally all of these dots would aggregate in the early, mid, later recession areas. So I think we're kind of here, but I would also suggest that this line, the economic growth line, might be shifted downward, and that a more accurate representation of where we are in the business cycle might be something that would have been called a contraction, but we're just bouncing off something close to zero. And it's a rolling kind of recovery. We had this potentially rolling recession last year, which will never get identified by the National Bureau of Economic Research as a recession, because the NBER, which determines these things, will look at all of these data and focus a lot on the labor market, wage growth, and other things and say, well, we didn't really have a recession. So while under normal circumstances, we would have something a little more pronounced in terms of a slowdown, it appears that because of the unusual nature of the economic environment that we're in and frankly, the recovery post-COVID, it appears that maybe this line of economic growth got shifted downward, and we're not going to get a full-blown recession. At least that's the sense now. I'm going to present a slide later, probably be the most important slide I present, which shows how do you actually get to an outcome where you do avoid having a significant slowdown or a recession, and that would be a soft landing, which is very rare. But we can't declare victory yet. And again, just to preview it, we're not going to be able to declare victory on the economic environment. We're not going to be able to say with a high degree of confidence that we've achieved a soft landing until the Fed normalizes interest rates. So while the Fed is evaluating dynamics in the inflation and labor markets, they're going to be laser beam focused on normalizing, taking interest rates down in a way that doesn't cause inflation to bubble back up, and we got to then restart the rate hike cycle. And they want to make sure they can lower interest rates in a manner that doesn't strangle the economy. Right now, the real policy rate is very high. That is, the inflation-adjusted policy rate should be high enough at this point to slow the economy meaningfully. And the Federal Reserve can fix that by lowering what they control, which is the nominal Fed funds rate. It's currently at 5.5 on the upper bound. But inflation is coming down. As inflation comes down, that increases the real policy rate or the real interest rate. And it's real interest rates or inflation-adjusted interest rates. That's the only thing that matters to the economy. It's not the nominal rate. Okay, so let me just take a little deeper dive and highlight what I've been talking about in terms of where are we in the business cycle? Who knows? Because you got some red, you got some dark red, and some U.S. Fed funds are very tight. The 10-year yield is high. Corporate spreads are low. The VIX index is very low. The equity market's been increasing lately. So looking at all of these, both financial conditions and leading economic indicators, they're all over the map. Whereas historically, going back, if this went back more than just a couple of years, you would see all of the colors lining up a lot more coherently and in a much more coordinated fashion than what we're seeing today. It's this highlight, there's no better illustration of this uncertainty about where we are in the business cycle than having this melange of colors here. There's no cohesiveness to it. So it's just very hard. They're very mixed. It's hard to tell where the economy's headed when you've got indicators, particularly the leading economic indicators, that are this mixed. So what's different? Well, I think there's a very simple explanation, and this will be the second or third quarter we've touched on it, so I won't belabor it. I'll just say this. There's a lot of things different about the recovery in 2021, 2022, that we're feeling the effects of now in 2024 that have elongated the business cycle and have extended or delayed a potential slowdown or a recession. But I think it's recession delayed, not necessarily recession denied. And you can boil all of the differences down to a much stronger consumer this time. The consumer, the engine of the U.S. economy, much stronger this time than in many other post-World War II cyclical recoveries because of the excess savings, and that was a COVID stimulus, the loan forgiveness, also COVID stimulus, plus the shifts in the labor market that allowed for labor supply to dip way below labor demand, giving consumers wage growth power, the power to negotiate higher wages, and higher real wages are a great place to spend from. So all of these factors lead to a stronger consumer than in prior cycles. Loan forgiveness went away in October. I thought the labor market was weakening, but that's a big question mark now. And excess savings, it's uncertain whether excess savings have been depleted or not. There's been some very interesting academic articles on what the amount of excess savings is. And frankly, not surprisingly, maybe academics disagree on whether or not excess savings are still a support or not. So all of these factors have changed the dynamics of the business cycle, have caused this rolling recession and recovery and basically made it very difficult for economists to predict where we're headed from an economic activity and a corporate profit perspective. It also makes it very difficult to understand the inflation dynamics or the outlook for inflation dynamics, which makes it then very difficult to assess what the Federal Reserve is doing. So just going back to the very first slide, everything you want to know about the economy to invest properly, where you are in the business cycle and what the Fed is headed, where the Fed is headed, the answer is it's about as uncertain as you can be. So the other uncertainty, and this is something we've touched on, I won't belabor it, is there's a couple different measures of economic growth. One is called gross domestic product. That's the one we're pretty familiar with. GDP is up around 3%, but there's another one called gross domestic income, which is the flip of GDP. These numbers should be the same. The R squared between GDP and GDI going back 70 years is pretty high. And you can see just by the chart, GDP and GDI seem to follow each other. But right now there's a massive disconnect. And in fact, it's the biggest disconnect on record. So again, just more uncertainty, more data to suggest that where we are in the business cycle is not something that we can have a high degree of confidence in. Yeah, go ahead, Julian.
Yeah, I was just going to ask a question with regard to slide 12. The question was about what year are represented in the peak, portion. What years did we have some peak in the economy
What years are the peaks and what quarters and peak? I mean, that's NBER has all that data. That what we saw, I assume slide 12 is which one is that? Is that the sine wave?
rolling recession? Yeah, the wave.
Yeah, that is a stylized business cycle. It doesn't represent. It's basically how we think about the business cycle. But you can actually, I mean, just going back to GDP numbers here, you can see the actual peaks and valleys in terms of economic growth. So this would obviously be a peak, and you'd have a valley here. So it depends on, we've had since the end of World War II, 12 or so peaks and troughs, so 12 full-blown business cycles, and all the data for them is on the NBER. In fact, I used to present a slide that had all the recessions. But in terms of like looking at slide 12 here, is this 12? Yeah, this is 12. This is not a particular date. This is a stylized business cycle analysis, what you'll see in, academics. So moving on to the biggest story of the last 2 years, and it's been 2 years now since the Fed got on their horse and started hiking interest rates to fight inflation. They've raised interest rates 11 times, but not since was it July? The end of July, I think, was the last rate hikes. But we got to 5.5 on the upper bound from basically 50 base, or the upper bound used to be 25 basis points. So 25 to 550, that's 525 and 11 stair-step kind of rate cuts, a couple of 75s in there, which were kind of a sledgehammer. But the economy has ignored it. At the same time that the Fed is raising interest rates, they are absolutely tightening using their other tools. And the other main tool of the Federal Reserve, of course, is the size of their balance sheet. So changes in the Fed balance sheets can either be characterized as quantitative easing or quantitative tightening. And we were in a quantitative easing mode post-COVID, right up until and including the time the Fed started raising interest rates back in March of 2022. By April of 2022, the changes in the Fed balance sheet flipped to negative. So now the balance sheet is declining in size. That's quantitative tightening. So you got QE here, QT here, with the exception of the 1 month in, that was March of 2023, so a year ago, to respond to the regional bank crisis. The Fed flipped and started offering loans and providing support. And you can see exactly what the Fed did to support regional banks. They didn't lower interest rates, obviously, but what they did do is provide a ton of support using the balance sheet as the lender of last resort to stop the bank run that was in progress. So interestingly, with all of this tightening, much higher interest rates, all of this quantitative tightening in terms of taking money out of the Fed's balance sheet, it's not slowed the economy yet. And the question is why? And beyond the idea that the consumer has been a bit of a fortress in the last 2 years or so, is this concept of a sluggish transmission mechanism. If you had all of your debt denominated in adjustable rate vehicles. That is, if you had an adjustable rate mortgage, if your car payment was adjustable rate, if your credit card payments were a significant component of your household debt, et cetera, if all of your debt was denominated in adjustable rate mortgages, then when the Fed starts hiking interest rates or adjustable rate debt, it would actually start biting. But I showed a slide like last time, and I'm going to replay it. This whole idea of a sluggish monetary policy transmission mechanism, is due to the fact that most households, most everybody on this call, has a fixed rate mortgage that they got in the last 3 years at less than 4%. So, and that's not going to change for 15 or 30 years, or until they sell their house and have to buy another house and get a mortgage today. At today's prices, that's a 6.5% or 7% mortgage. But having a 3.5% mortgage is a huge benefit. You're immune to the hikes in interest rates that the Fed has produced. Corporations have the same kind of insulation. It's not as durable. The government, which is the other big borrower in the economy, has insulation from Fed rate hikes. But think about corporations again, just for a second. Most corporate debt is fixed rate with an average maturity of, call it 4 or 5 or 6 years. It's probably closer to 7 or 8 years, but there's a lot of debt that needs to be refinanced at the corporate level in the next 3 to 4 years. Well, when that happens, then corporations will face the full impact of Fed rate hikes. So all I mean to say when I suggest that there's been a sluggish monetary policy transmission mechanism is most borrowers have fixed rate debt. And as a result, they do not face the impact directly of Fed rate hikes, but they will. It just takes time. So here's a concept that I want to highlight here. Right now, it's a foot race. It's a foot race for the Fed to lower interest rates to be able to get inflation comfortably under control. They're in no hurry to lower interest rates, by the way. The labor market is too potent for them right now to lower interest rates. So the Fed is in no hurry, but they might have to hurry a little bit later if they leave rates too high for too long. They'll choke off the economy and drive the U.S. Economy into a recession. That's possible. That would be obviously the opposite of a soft landing. So the foot race is, can the Fed lower interest rates because they've got inflation under control before the impact of their 11 rate hikes start to bite the economy and slow it beyond what they were shooting for and take us into a recession. That's the tug of war right now. Can we get inflation under control fast enough to provide some comfort to those borrowers who will eventually, households and corporations, be exposed to higher interest rates? Julian, question?
Yes, just adding the federal deficit to the equation, how do you take that into account, and why are the market really not worried about increasing federal deficits?
So federal deficits used to have in economic theory, federal government deficits used to have a significant impact on interest rates, but they don't seem to have the same impact on interest rates now. And they never had the same effect on interest rates for whoever was the reserve currency of the world. So as long as the US dollar remains the reserve currency, we do have more degrees of freedom to both issue debt and, frankly, to print money. So while the traditional economic theory suggests higher budget deficits crowd out private borrowings, which make the competition for borrowings more competitive. That is, you got to pay more. That is, that interest rates go up. You got to induce people to borrow money from you on the private side. It hasn't happened. It hasn't happened because of a confluence of events that has a lot to do with our reserve currency status and, frankly, call it international capital developments that have allowed us to maintain a strong demand for US dollar assets that keeps that accrues to whoever the reserve currency is, and that should maintain. There's not a really great explanation for why budget deficits no longer have a direct implication. In the 70s and 80s, they did, when the bond market vigilantes were running rampant, and they were trying to force the government, particularly government debt yields, went higher because they were being sold by government government bond traders. But the reality is there's no other substitute for US dollar debt. So the implications of our budget deficit are muted by the fact that the The world is also hurting from a deficit perspective. You got to think about currencies and, frankly, budget deficits not in a vacuum. Just because the U.S. budget deficit or our debt to GDP is very high, you have to compare it to everybody else's. And the phrase we like to use is that the U.S. dollar remains the cleanest shirt in a dirty laundry. All the currencies have the same sort of dirt attached to them as we do, but we're just the best one of the bunch. So hope that helps. Again, I don't want to belabor this chart except to say that at 3.8%, the weighted average mortgage interest rate's never been this low. Everybody refinanced back when 10-year yields were close to 1%. Their mortgages. In fact, this is 55% of all the mortgages that that are originated today were done during a very low interest rate period. So just to highlight the fact that nobody's got and it used to be 40 or 45% of all mortgages 12 or 15 years ago. 15 years ago, 40% of mortgages were adjustable rate. That's not the case anymore. Most mortgages are fixed rate, and now most mortgage rates are in the 3 3/4 bucket. So if you got a rate lower than 3 3/4, good for you. It's because you refinanced in the last 3 years. If you refinance tomorrow, you're going to turn your 3.5 into a 7. That will allow the Federal Reserve's rate hiking cycle to actually impact your disposable income, which would cause you to spend less, which would cause the economy to slow. But in the meantime, everyone's enjoying very low mortgage interest rates and will for the foreseeable future. So let's move on to inflation and the Fed real quick. We're going to get another inflation print in a couple of weeks, but right now, core CPI inflation is hovering just below 4%. That's still too hot. But looking at the headline CPI number used to be 9%. This goes back to June of 2022. And now it's 3%, so it's a third of what it was. But longer run, the CPI needs to be closer to 2.5. So we're at 3, need to get to 2.5. We're pretty close. I'm going to show you some slides that suggest the momentum is real good. But if you want to know what the Fed's objective is or what they're going to do at their next meeting in March, you got to look at inflation. They have a very, very straightforward mandate. If inflation is too high, they need to continue to tighten financial conditions. They need to keep interest rates high. They'd like it if the stock market wasn't so bubbly. If it is bubbly, they would certainly like the stock market not to have such high levels. They would like to have house prices kind of moderating or coming down. They want to see economic activity slow because by slowing economic activity, they take the steam out of inflation. But they haven't been able to do that. And they need to continue. They're not going to be in a big hurry to lower interest rates as long as inflation is still well above their 2 or 2.5% target. 2.5% for CPI, 2% for core PCE. Here's the interesting data, I think now, is if you look at, for example, the headline CPI number, which we saw over here is 3.1%. So that's 3.1% is the headline number. But the dotted line here is the 6-month annualized number. And that shows you where the momentum is headed. So as long as you're on the same kind of path, 6 months from now, inflation will be closer to just under 2% as opposed to 3%. And that puts the Fed back on track. Here's the inflation measure that the Fed really cares about. It's PCE core. PCE core year over year is still at 2.4. That's above their target. But if you look at annualizing the shorter term numbers, the recent data, which is the momentum for the year over year, it shows a much lower than 2%. The Fed's there. They're taking comfort in this data. So this is on the positive side of, will the Fed cut rates in 2024? The answer is the inflation data, both the year over year numbers and the more recent data is suggesting the answer to that question is yes. The labor market and how strong the labor market is on the other side of the ledger, which says that they might not be in that big of a hurry. Because even though inflation is heading downward, if the labor market continues to be strong, if the economy continues to be strong, the Fed's concern is that there's a reversal. And that inflation, while the momentum is good now, will turn around, and you'll see something a little less beneficial, a little more nefarious from the Fed's perspective. And the Fed is going to be really cautious about this. Which, by the way, if the Fed's bias is to keep interest rates higher for longer in order to make sure that they've slain the inflation dragon, the probability of a soft landing goes down. That is, the probability of a harder landing increases, because as long as the Fed keeps rates very high, especially on a real basis, as long as rates are high on a real basis, the economy it's not quite choking off economic activity because it hasn't had the influence that it should because of the sluggish monetary policy transmission mechanism. But eventually it will bite. And the longer we're at 5.5%, the more likely it will bite and the harder it will bite. And the Fed knows that. They want to make sure their primary objective is to make sure inflation is back under control and close to their 2% target. And they won't stop until that's the case. And this chart, I love to present it because it basically says everything that's happening right now is totally understandable from the Fed's perspective. The Fed has one mandate, and that's stable prices. And they have another mandate. It's called maximum employment. So those two are, by the way, diametrically opposed. You can't have maximum employment and hope to have stable prices for very long. So the Fed's dual mandate, they either have to focus on one or the other, and they have to fight inflation, and they fight inflation by tightening financial conditions, because tightening financial conditions today reduces future economic activity and raises the unemployment rate. And by doing so, they reduce price pressures. So what does the Fed have direct control over? They can increase short-term interest rates. That generally reduces the S&P, increases the S&P vol. We haven't seen that at all. We've seen the opposite of that. So while the Fed has increased interest rates, it's being offset by higher stock prices and lower stock price volatility. It's also being offset by wider corporate bond spreads. The U.S. dollar has appreciated, and that should slow international activity, and it kind of has. So you've got these varying effects, but the bottom line is all of these are related to financial conditions, and it's just it's a roadmap for what the Fed's doing. It's completely explainable. Here's the financial conditions index in practice, and by the way, it's highly correlated, or has historically been highly correlated to the stock market. So when the stock market goes down, financial conditions tighten. When the stock market goes up, financial conditions loosen. And we've seen a bit of, kind of back and forth in the last year or so. In the last 3 months, it's been a tremendous loosening of financial conditions. Stock market's on a tear. I don't know, Julian, we probably saw, I don't know, how many record highs on the S&P in the last couple of months. Been a lot. 12? I don't know. Do we have that number? I don't know. It's been a lot. So go ahead.
No, I'm afraid I don't have the data, but I can get it before the end of the call.
Yeah, I mean, it's simply a lot of record highs, and every time the stock market keeps going up, we can talk about whether that's a good time to invest or not. We'll do so later in the call. But the idea that you've got this record high equity market, and the Fed is trying to push back against that. That's been our thesis, is why we've been defensively positioned, because the Fed generally gets what the Fed wants. But a couple of things have overwhelmed the Fed's activity and the Fed's desire to lower economic activity. And it has to do with the strong consumer, the sluggish monetary policy mechanism, and frankly, as it relates to the equity market, developments in artificial intelligence. So this is what I think we're kind of looking at. We had this stimulus back in the 2020 post-COVID. The stimulus caused inflation. The Fed started tightening. And then you've had this extended period where you've had a Goldilocks kind of an outcome, and a lot of hope for a soft landing. But I'll get to a slide in a minute, which shows we can't declare victory yet. There's a lot of work that needs to be done before the Fed can declare victory. What is the Fed thinking about right now? What's the market thinking? And the answer is, how many interest rate cuts are priced in? And the answer is 4. 4 cuts are priced in over the course of the next 12 months. Used to be 7. Back a couple weeks ago, 6 weeks ago, 5 weeks ago, the market was thinking we were going to get 7 rate cuts in 2024. We didn't think that was likely, but interest rates have risen. The likelihood of more Fed rate cuts has kind of dissipated, and that should cause the equity market to go down. That is, if the equity market is at 4,400 and you've got 7 rate cuts priced in, and now you only have 4 rate cuts priced in, Should the equity market be at 5,000? No, probably not. Yet it is, because the outlook for earnings growth, that was the third leg of the stool. Economy, inflation, corporate profits. Corporate profits, the outlook for earnings is actually, in AI in particular, is overwhelming the outlook for the Fed at the moment. So I just want to highlight that. Labor market, I'm just going to say the labor market has been usually strong. We thought the labor market was weakening in the fourth quarter of 2023. Yet it's rebounded pretty dramatically. And I'll show you that here. This is the non-farm payroll numbers. So non-farm payroll seem to be, on average, coming down to something pretty manageable. So these are the monthly non-farm payroll numbers. The two most recent have been above 300,000. This is January and February non-farm payrolls. I mean, just a stunning result. There's a data metric that was created by an economist named Sam that suggests if you have these changes in the unemployment rate, if the unemployment rate goes up a certain amount, it means you're probably in a recession. And last time we spoke, this number, the SOM indicator, the SOM rule indicator, was bumping right up against the recession levels. And we thought we were going to go above the recession indicator level, the threshold. But in fact, what we got was a stronger labor market. So again, economists are rarely, precisely right. We just need, as investors, our economics, when we have our economics hat on, we just need to be right on direction. Well, that's been very difficult. I think we kind of got head faked here by the SOM rule again. Let's see. This is operating earnings. Since we're talking about the one item that seems to be driving the equity market beyond what you would expect given the Fed outlook, it's earnings. And right now the market is looking at $244 of earnings in 2024, and then up another 12% to $274 in 2025. This is a pretty benign outlook for earnings. It's pretty Goldilocks to me. It doesn't include any kind of a recession. If this will happen, most likely if the Fed can engineer a soft landing. And this is just the year-on-year earnings growth. So 11% up from 2023 to 2024, and then another 12% up into 2025. These are the consensus estimates. Whether they hold or not remains to be seen. Question, Julian?
Just getting back to you on the S&P 500 all-time high. So we had 7 in January, and looks like it's 6 so far in February. So it's almost like 14 for how many trading days? We probably had like 30 trading days so far this year.
Every other trading day is a record high in the S&P. And that will continue. That can continue for, I haven't seen the data lately, but a year ago I saw some data from BlackRock that just suggested that investing in the stock market at record highs isn't a bad deal. It seems uncomfortable. It seems like, well, we're at a record high. What's going to happen? Couple of points really quickly. One, you don't know if the record high is, the first or second or third inning, or if it's the 7th, 8th, or 9th inning of the rally. And point number 2 is you don't care really if you've got, because you can't time it. So you don't have any information advantage to tell you that, oh, it's really a good thing to dollar cost average, or it's a really good thing for me to wait to invest. Because what if the market goes up 10 or 15% from here? If the market goes up 10% from here and we're at 5,500 on the S&P, and then it goes down 15%, you're really only down, 5 from where you invested. Do you care that you're down 15? It feels bad. And yes, you want to look at that down 15 and say, ugh. But the fact is, your weighted average time in the market is enough, and you probably got a lot of credits built up for the last 3 years. Where down 15 doesn't really matter that much. And all that matters is the longer run anyway, unless you're going to retire next year or in the next 3 years. If that's the case, or if you're a foundation or endowment that happens to have a significant capital project in the next 3 years, you really don't care about the short-term wiggles in the equity market. You don't. You want to, and it feels bad, but if you're thinking about this like an investor, an institutional investor, you realize that these are the wiggles and that the trend is what matters. Julian?
Yeah, just on another question on I guess previewing the next slide actually, which is about broadening out the market. We talk about a Magnificent Seven, being responsible for most of the performance. When do you expect that to change?
Oh, I don't have any expectations on that. That is so unknowable. I mean, you're asking a guy and a team, our team, collectively, we make a bad call, it's, I'll take responsibility for it. So, I mean, I didn't see AI coming, and I didn't see the market, the narrowness or the lack of breadth in the market that has caused interest rate fluctuations to seemingly have no effect on the stock market, which is being primarily driven by the Magnificent Seven. These are the seven here. Bottom line is, what we're looking at is in 2023, when NVIDIA, by the way, which is up 200%, it's probably up 40% this year already. It's up 15% today with the earnings blowout number. It's just astonishing what NVIDIA has been able to do. These people just print money. I'm going to talk about NVIDIA just for a second. So there's an analogy I read, I think it was a Barron's article this morning, post NVIDIA, that suggested that, you don't have to pick people want to try to pick the winners in AI. Why haven't we, gone all in on AI? So, because I don't know who the winners are or who the losers are. So you don't pick individual, it's hard to pick individual stocks. Julian made a good comment earlier today to me when we were talking about valuations in the equity market. And he suggested, as long as you own the S&P 500, you're going to get the benefit of owning, the S&P is 30% of the S&P is these companies. So you're going to own them as long as you have a broad, diversified portfolio. The other point I kind of want to make is that, look, we don't know, again, who the winners and the losers are, but if you can find the folks that are providing the infrastructure for AI, and a good analogy was NVIDIA is like selling shovels during a gold rush. They're the people that get rich, is the folks that are, investing in NVIDIA, because NVIDIA, it's table stakes to get the chips in that NVIDIA produces to get on board with AI. It's the entry level. So NVIDIA is like the shovel in the gold rush analogy, and the folks that sell the shovels are the ones that are the only ones for sure to get rich, not necessarily the folks digging for gold. Julian, question?
No, I was just going to add, so NVIDIA added today 250 billion of market cap, which is about the entire value of Chevron or Coca-Cola, just to give you an idea of the magnitude of the move today. But as Michael said, if you're in a portfolio that's benchmarked and tightly benchmarked, as we do to the ACWI or to the S&P 500, you're going to own your fair share of NVIDIA. So NVIDIA was probably like 0%, 0.5% 3 years ago, and now it's about 4% of the S&P. So if you tightly benchmark, you would have that exposure that will allow you to perform pretty much in line with the market.
Yeah, I like I said, we don't pick stocks, individual stocks. It's very difficult to do that. So, and if you do pick stocks based on valuation metrics, it would be hard to invest in the Magnificent Seven. This is just a valuation chart. It's got price to sales and price to earnings. So your PE ratios for NVIDIA, this goes back a couple of weeks now, was 62 times. But given their outlook for earnings, this number can come down very quickly if they actually start updating their earnings, which is the denominator in the PE ratio. If they start updating their earnings and increase them dramatically, well, then you got to be willing to pay a lot more for them. So while PE ratios are interesting to look at, they're not a great forecasting tool. They're not a great trading tool. However, if you're a fundamental analyst, one of the things you want to know is what's the PE ratio. The PE ratio of the S&P 500 was close to 23 times a couple of weeks ago. If you look at equal weight, which takes out the effect of the Magnificent Seven, it's below 19 times. So the rest of the market looks relatively inexpensive versus some of the Magnificent Seven or the NASDAQ, but the NASDAQ's ripping up. The NASDAQ was 2.5 or 3% higher today. So, it's hard to know. Basically, if you were looking at this thing from a what I would call a rational fundamental analyst perspective, it's hard to get excited about buying these stocks, which, by the way, is why we are slightly underweight growth stocks in the portfolio and slightly overweight value stocks in our portfolios. Always look at, again, price earnings, try to get, if 244 is the earnings, but we get, 8% less, well, then unchanged PE ratio, we're going to have, the stock market is going to go down 8%. So I always like to look at some sensitivity analysis when trying to figure out what exactly the outcomes could be for the stock market. And again, it always boils down to the Fed and corporate profits. If the Fed's raising interest rates, the PE ratios generally come down. If the Fed's lowering rates or is expected to lower rates, then you can generally see the equity market supporting higher PE ratios. It's no more complicated than that. Then you have to figure out, again, where you're in the business cycle, which if you're in a recession means earnings are likely to decline. If you're in an expansion or a stable kind of late stage environment, earnings can grow, 5-10%, whatever. So that's what the sensitivity table's for, is to kind of compare where you are today and see what the potential outcomes are. But here to me, I think is the key chart for thinking about if we're going to get a soft landing or not. So here, this chart answers this one, and the next one answers the question, are we going to get a soft landing? This is the real Fed funds policy rate, is the orange line. And when the Fed is accommodative, the line is below. When the Fed is trying to slow the economy like it was back in 04 through 06 to 07, it's above the line. The Fed's trying to slow the economy now, so you've got almost a 2.5% real policy rate. The policy rate, the midpoint, not the upper is 5.5 of the Fed funds rate. The midpoint of the Fed funds rate right now is 5 3/8. So 5 3/8 minus PCE core year over year, which is about just over 3%, just under 3% now, 2.9. Take 5.3 minus the inflation rate, and you get the real policy rate, which is now at about 2.5. It was minus 5.5% back in the end of 2021. It was the lowest and loosest, hence the lowest negative real policy rate is loose. It was the loosest monetary policy ever. This data goes back 30 years. Just know this, the Fed needs to cut rates in time to make sure that they don't choke the economy out. This should be restrictive. This should be slowing the economy, but it hasn't bitten yet because of why? A sluggish monetary policy transmission mechanism. But that doesn't mean it won't ever happen. It just means it's been pushed out a quarter or 4. So it's going to slow the economy. The Fed's going to have to get this rate down. So here's where we are today. Call it 250 on the real policy rate. This is more recent data with a forecast. The forecast suggests that we cannot say that the Fed is done with their work until policy rates are normalized. They still need to thread the needle to land this plane. What is a normal policy rate? Near zero on real Fed funds. They're 2.5%. They're 2.5% away from getting the real policy rate to zero. What does that mean? That means taking the nominal rate from the midpoint here, 5 3/8, to something closer to 2 1/8, 2 or 2 1/8. That's the normalized rate for the Fed funds rate. It should be somewhere between 2 and 2.5%. So a real policy rate of about zero makes sense to me as a normal rate. This is the forecast. I mean, we are not there yet. They have to navigate the normalization of interest rates, taking rates from 5.5 back down to 2. And they have to time it right so that A, they don't start too early in the rate cut cycle, which would allow inflation to bubble back up. And they can't wait too long, which will choke the economy off because policy rates are too high. And then we have a recession. That's not a soft, neither one of those is going to end in a soft landing. If inflation bubbles up, then it's not a soft landing because they got to keep rates higher for longer, which eventually a recession will ensue. That's just the way the economy works. You keep real interest rates in the economy high, the economy will slow. And because the economy is not a Swiss watch that you can fine tune with very precise instrumentation, it's not. It's got a lot of cross currents. There's a lot of different things going on in the economy. It's impossible to fine tune it. That's why the Fed's job is so hard and why they can't declare victory until interest rates get closer to these numbers, and they're at these numbers today. Julian, question?
Yes, a question to preview the next section. Actually, we're in 2024, an election year, and it's on everybody's mind. What does it mean in terms of portfolio investing, volatility in the market?
Short answer, not much. We've gone pretty far into the time, I realize now, and we haven't gotten to the cash or to policy. So the summary of the section is you do get sometimes some volatility during election years. These are election years going back to 1928, and these are the number of days that the stock market was up or down 2%. So it indicates, there's volatility. I mean, so far year to date, we haven't had any plus or minus 2% days. We may get one today, but all the more volatile days, and again, it doesn't matter who the president is or who the administration is. It doesn't matter. It's volatility equals lower returns. And the largest vol days are actually occurred during election years when there was large recessions. So the point I want to make here is, while these are election years, and this is a measure of stock market volatility, plus or minus 2% days, the biggest days of volatility it was just coincidental. It was an election year. It just happened to be a recession year too. So we get about 20 days on average of plus or minus 2% over the last 20 years. We only had 2 such days last year. And that was part of the reason why we had such a good stock market. But again, these are election years. This is the volatility, and the big vol days wasn't a factor of the election. And that's a theme, by the way. I'm gonna hit on that theme, that there's other things happening besides the election, and frankly, who's in charge, who's in the White House in particular. Matters a little more what Congress is doing, who controls Congress. Just to put a little, here's the popularity contest. It's a national question. It's asked across the country, who will win the election? And right now, Trump is ahead 46-41. Note Gavin Newsom, the governor of California, gets 12%. You could probably consider the possibility that some of the folks who answered Newsom, once he is out, it's going to be Biden-Harris versus Trump and question mark. There is no, it's a, I don't know, not a conspiracy theory, but it's a fantasy to think that there would be another ticket. Barring, a health emergency of some sort, it's going to be Biden-Harris. There is no scope for the Democratic Party to swap out an incumbent presidential candidate. I say that with 99%, 98% certainty, barring a health scare of some sort. So right now, this is interesting, but it doesn't matter. It's not a popularity contest. It's electoral votes. And again, these 6 states these are the electoral college votes for 2024. California's down to 54 from 55. Texas is up a couple. It's up to 40 from, I think, 37. We'll see on the next map. But anyway, the toss-up states, once again, you can ask the question, who do you like for president? And there's going to be, you may get an answer you like or you don't like. It doesn't matter. The answer is, who can win 270 electoral college votes? And here's the way it shakes out right now. There's pretty solid Democrat of 191 of them, and pretty solid Republican or leaning Republican, 121 plus 97, or 218. So it's going to be a close one. And by the way, we've already started the general election. So should expect volatility to go up, because it's going to be brutal and divisive. And we probably will have a contested election again in November. Given the current environment in the country and the willingness the commitment of each side to their candidates, and frankly, the erosion of certain norms related to the institutions, and frankly, respecting, electoral, the state's ability to run elections. These things argue for another divisive election and a potentially contested election in November. So it could get volatile. It's certainly going to be brutal and divisive. And that could increase volatility in the stock market. Just a quick, here's what happened. Everybody moved from California to Texas. Texas picked up 2 electoral college votes. So the Republicans actually picked up 2. If you look at the electoral college map, I'm highlighting the electoral college maps again. I always do during an election year, because popularity contests don't matter. All of the folks that are on the campaigns for both Biden and Trump are doing this math. This is the only math they care about. It's the only math we should care about. Senate control, House control. Again, here's the current consensus for the Senate: 47 Dem, 50 Republican. There's 3 toss-ups. You could have a 50-50 Congress again, and then the vice president will make the determination. This is a note here. You can't read. I put it in there to remind me to mention that this is the most important factor when it relates to the impact of government control on policies which affect the stock market and the bond market. The answer is you need 60 votes in the Senate to legislate anything. So you're going to get a divided government unless you can get one party in the White House, the same party controlling the House of Representatives, and the same party having 60 seats in the Senate. And since that is not likely and wholly, it's a 6 standard deviation event in the current environment, you should expect that all of the rhetoric you're going to hear between now and November 5th, when the election happens, is really for campaign purposes. It's not for legislative purposes. So think of it like this. People can talk all they want, but they cannot implement their legislative priorities without control of the Senate. And you need 60 votes to control the Senate. So everything you hear about what everybody's going to do once they get into power is a bunch of nonsense if you don't realize what the legislative constraints are. And the legislative constraint is 60 votes in the Senate. So a lot of what you're going to hear is not implementable and should be completely discarded as campaign rhetoric and an attempt to get elected and energize your voters to get out and elect you. That's what it is. So as an investor, just to be really clear about this, as an investor, it's incumbent upon me and our team to ignore most of the campaign rhetoric because it is not implementable. And only implementable policies will have an impact on the economy, interest rates, and the stock market. I've said it. You can look, by the way, at any amount of data that suggests almost universally that the Dems are better on the economy and the Republicans are better for the stock market. This is election or administrations with unified Republican or unified Democratic or divided government. Divided is gray. Unified Republican is red. There hasn't been a lot of unified Republican. We haven't had a lot of unified governments at all. 60% of the time we have divided government. That means, one party or the other controls one of the House, Senate, or White House. You don't have all three, the House, Senate, and White House being controlled by the same party. So, but here's the thing. You can look at a bunch of other data that flips this on the side. What period are you looking at? What economic data? I mean, here's a bunch of economic data. All of it says, half of it says the Dems are better than the Republicans, and half of it says, and a third of it says the Republicans are better than the Dems. I mean, here's what happens. There are other factors that are much more important when it comes to the stock market and the economy, and that means corporate profits and the Fed. Again, politics and who's the president are not on the list of the things that are most important. They're somewhat important when it relates to making money for clients or protecting client assets. That is, actually investing. You may have other concerns. I don't. We have one concern at Beacon Point in the investments team, and that is to protect client assets and grow them, taking only compensated risks. And there is no way to measure or, frankly, invest in some of the risks that are associated with campaign rhetoric, and you wouldn't want to anyway because they're not long lasting. So there may be higher volatility, but in the long run, 2 years from now, the campaign promises that are made today will be completely forgotten by not just voters, but by the stock market. So what are the things that do matter? It appears that if you look at some of this data that suggests the Democrats are better on the economy, that there were other things going on that helped, kind of bail them out. Like, first think about this. The policies that are legislated during a particular period of time extend beyond who's in the White House and, frankly, who controls that chamber. More often than not, policies get enacted years before. So just trying to pinpoint who's in charge at a particular 4 or 8 year period has nothing to do with the actual policies that relate to the economy. So that's point number one. The other thing is, total factor productivity, a more favorable international environment, whether you were president when there was an oil supply shock, sometimes when you get a Democratic president, there's a bump in consumer expectations about the near term. These are the things that happen that may affect the economy, economic activity, and hence the stock market. But it's not really about it. Here's a chart Stephen Marshall presented, and then I'll pause for a second. Just going back to the 70s, we put $1,000 in the stock market on the last day of 1969. doesn't matter whether there's a Democrat or the Republican in the White House, you still made 260, you're 260,000 now, 265% growth rate. So there's just way too many stocks go up no matter who's in the White House. Julian, question.
Yes, and we have 25 minutes left and 2 more sections to cover. So let's move on maybe to cash and the illusion of safety. And there's like 6 trillion in money market accounts, and it feels very comfortable owning cash at 5%, risk-free assets. Why should I now, go into equities or at all-time high or in high yield or other securities?
So you shouldn't necessarily, but you should definitely not be in cash. So here's the 6 trillion Julian referenced in money market funds and total assets. It's grown dramatically from about 4.5 trillion just 18 months ago. So a lot of folks are in the same boat. That is, they look at 5% on cash yields and think that's great. So money market yields, by the way, are highly related to Fed funds. So this is just data going back to 1999, which shows since 99, there's been 3 rate cut cycles. Here's where we are today in terms of 3-month T-bill or 6-month T-bills and the federal funds rate. Fed funds rate and 6-month T-bills. And by the way, I'm using 6-month T-bills as a proxy for money market yields. A lot of what's in a money market yield is short, T-bills. So 6-month T-bills is your money market yield. Fed funds is Fed funds. Fed funds are controlled by the Federal Reserve. The Fed lowers interest rates, and 6-month T-bills or money and all money market yields drop dramatically. So if you think the Fed's going to cut rates, just know this: money market yields are going to go down. Cash is not a retirement asset. It's a purchasing power enzyme. It destroys purchasing power. In fact, if you look at the inflation adjusted value, even just in 2023, this is 1 year ended December 31st. If you put $100,000, if you just stuffed it under your mattress, which feels good, right? To have cash lying around, that means not even in T-bills. You gave up purchasing power to the extent of the CPI increase. So about 3% of purchasing power, because the 3.5% was the average CPI for 2023. So your 100,000 is only going to buy you $96,000 worth of stuff. If you put it in a T-bill, thank goodness, on an inflation adjusted basis, T-bill yields were 5, but inflation was 3.5. So your real yield, this is inflation adjusted value of 100,000, adjusting for inflation. That is, what can I buy with my $100,000 I had a year ago? The answer is I can buy $101,000 worth of stuff with 30-day T-bills. If I put the money in bonds, I could buy $102,000 worth of stuff. And it was a really good year for stocks, so this doesn't happen every year. In fact, if this was 2022, the number would be closer to 80,000 because stocks were down 20% plus. So, but it was a good year for stocks. So if you put the money in the stock market a year ago, now you got on an inflation adjusted basis. That's why stocks are so good. And over the long run, these numbers you cannot argue with them. If you stuffed $100,000 in the mattress today and then pulled it out 30 years from now, you can only buy $47,000 worth of stuff. And in cash, you can only buy 93. Cash over long periods of time does not keep up with inflation. It's a purchasing power enzyme. Bonds, on the other hand, you'd be able to buy $155,000 worth of stuff. That's pretty good. But if you had in the stock market, you could buy almost $900,000 worth of stuff with your 100 grand for the last 30 years. We may not see that same, past performance. There's no guarantee, et cetera. But stocks are higher risk and hence they're higher return. This is the inflation data. We saw a little bit of this before. I'm just going to highlight a couple of things because it does suggest that the Fed can and will likely lower interest rates in the near future, which says money market yields are not the return you should expect. Money market cash yields do not equal the return. There's a great slide I'll show you on the next one. Interest rates could be down between 100 and 150 basis points in the next 18 months. Here's the inflation data. We actually looked at some of this earlier, but I added the 3-month annualized. So this is the year-on-year data. This is the 6-month. This is the 3-month annualized. The momentum for inflation is down hard. That means the Fed can lower interest rates. That means cash yields are coming down. Julian.
So if I have cash today, I need to invest. Should I buy at all-time high or should I just wait?
Don't wait. You don't know if this is again, we talked about this earlier. It doesn't matter. You can't time the stock market. If you're a 60-40 or 70-30 investor and you have cash to deploy and you're really, really worried, at least go into bonds. And at the very least, go into what I would call 2-year treasuries from cash. There's an index called the Merrill Lynch U.S. Treasury 1 to 3 year. So this is the returns, by the way. These are the yields on Fed funds from one rate cycle to the next. We saw the rate cycles were started in Jan of 2001, Sep of 2007, and August of 2019. These are the 3 rate cut cycles. What you see is rates are down 400 basis points here, 300 basis points here, 200 basis points here. So Fed interest rates can come down very quickly over the course of a year. Okay, point number 1. During that time, your cash return, your return on 3-month T-bills was 3.5 in the first rate cut cycle, 2.5 in the second, and 1.5 in the third. Even though you started in the most recent rate cut cycle at 2.1% on cash, because on average, your cash rates are coming down, you're reinvesting at much lower rates. So your return, these are returns, these are yields, these are returns. Your return on cash is 1%. Whereas if you had only, on August 19th, put the cash money you had in 2-year treasury bills, you would have returned you would have gotten a 4% return. So again, current money market yields do not equal returns. You need to move off of cash and into bonds. Merrill 1 to 3 or a 1 to 3 year treasury portfolio, a 1 to 3 year U.S. treasury portfolio. So an average 2-year treasury portfolio is not that much riskier than cash. But if rates come down, the returns are much better, much better. And that's just the magic of having, pure interest rate duration or duration in the portfolio. There's another concept here that I think is interesting. If you do want to go out further than 1 to 3 month treasury bills, or 1 to 3 years, sorry, you can go to 2-year treasury bills, you can go to municipal bond index. If you're in T-bills, the average after-tax return 3 months before the first Fed rate cut is 3%. Whereas if you're in, 12 months after, if you go from T-bills to the municipal bond index, 3 months before the first Fed rate cut, and then look 12 months beyond that, your total return in bonds is almost 11% after the first Fed rate cut. Early bird gets the worm here. Go where the puck is headed. So basically, if you think rates are going down and you're very risk averse, the first thing you should do is buy 2-year treasury bills or 2-year municipal bonds, either way. Second thing if you're a taxable investor, the next thing you should do, if you're a little more confident in our forecasts, you should invest in a core municipal bond fund, because the after-tax returns of T-bills versus bond funds vary dramatically. And it matters when you actually invest, okay? When you get involved. If you wait until after the first Fed rate hike, you still do much better in bonds than in T-bills. Again, these are 12-month. If you invest 2 months after, you're looking ahead 12 months, this is what your return would be, if that makes sense. Julian, was there a question? No questions, Julian?
Yes, Michael, I guess that just to conclude on the cash exchange, so don't stay in money markets for too long. And then I guess a few questions that I think would be helpful to preview the last section on
Okay.
How to position the portfolio.
Okay.
In particular, I guess one question about buying options to protect the equity side of the portfolio. Is that something that should be considered to protect to the downside? And another one is about if you can think of any black swan event in 2024.
Well, the black swan event is defined as something that is completely unknowable before it happens. Like COVID was kind of a black swan. The great financial crisis was not. So the answer is, in terms of black swans, no, I can't think of one, and no one else can either, would be my answer. In terms of using options, if you are comfortably using options, they are a great way to protect the portfolio on the downside by buying put options at S&P/X index at 85 or something. I'm not recommending any option strategy to anybody in particular. Contact your advisor or your consultant to talk more about that. But the answer is, that's what options are there for. They're conditional payoff vehicles that allow you to protect the downside. On the other hand, more often than not, purchasing options, you pay for the privilege of the comfort. So if it makes you sleep better at night, great. But frankly, it detracts from your total return. And since you need to kind of time it pretty well, that is, you need to buy a put option that that pays off in the next 3 to 6 months, as opposed to buying. You can't just buy a long-term option. It's an expensive proposition. You're going to detract from your overall total return. Investing is easier than that, by the way. Investing is easier than that. That is a strategy that you can use that we support at Beacon Point. We have a lot of folks that, particularly folks with concentrated equity positions, that want to protect the downside or idiosyncratic risk of an individual stock position or a group of stocks or an industry. But in terms of doing that for the overall portfolio, take the volatility, accept and welcome and embrace the volatility that is inevitable in the stock market, because volatility is the price that you pay for building wealth over the long run. It's impossible to time it. It's difficult to hedge against it inexpensively. It's impossible to hedge inexpensively. So kind of, let it go, as they say in the Disney movie. It's not that, it's painful and it's difficult, but if you stay the course, you stay invested, and you're taking the proper amount of risk the entire time that you're on board, and you're letting Beacon Point strategy portfolios take some of that, the burden of knowing if you're properly positioned. A strategy portfolio of Beacon Point, by the way, is fully optimized to take no uncompensated risks. We can measure compensation for risk taking, and we're building portfolios that only take compensated risk. And even better, we run them through the super collider here that Julian runs, Bloomberg Port and BlackRock 360, which is a stripped down version of their Aladdin Green package. The type of risk models we're using in the portfolios give us the greatest degree of confidence possible. There is no other way to look a client in the eye, frankly, than if you're not using a risk model and say, we are confident we're taking compensated risks, and frankly, that your portfolio is the appropriate factor risk level and will get you the returns you need with the fewest bumps in the road. Because we are going to achieve what the market's going to give us. We're going to extract from the market exactly what it's offering you. No more, no less, versus your designated risk profile, whatever that is. Everyone's got a unique risk profile, but everyone's risk profile can be quantified. So we quantify your risk profile and say, that's the benchmark, 70-30. If you're a growth client, you're a 70-30, you should expect to get something on the order of 70% MSCI equity returns and 30% ag or 30% municipal bond returns. If you're not getting that, you should be, because that's what the market's offering you, and that's the risk profile that best suits you and will allow you to achieve your investment objectives. Risk modeling is the only way to get there. And since not everybody uses risk models, but institutional investors do, our portfolios are highly risk controlled to make sure we're protecting on the downside and getting the returns that are on offer in the marketplace. Okay, we got to go to positioning the portfolio. I think there's a couple other questions in the chat. They're all very good questions. We'll try to get to them. But most importantly, the first thing you want to know when positioning a portfolio is what's the return of the overall portfolio, and can you count on, for example, bonds to provide a hedge? And this is the stock bond correlation chart. It goes back to 2006. When inflation is high, stock bond correlation is positive. When inflation, which is the average CPI, are these numbers here. When inflation is low, stock bond correlation is negative. And when it's negative, it provides a hedge. What happened in 2022? Bad things, because the stock market went down and because interest rates are rising, so the bond market went down at the same time. So you didn't get any hedging. Good news, it looks like the very high levels of stock bond correlation that we saw, that were the proximate result of stocks down, bonds down in 2022, it looks like there's a better outlook for bonds being able to hedge stocks going forward, which is kind of like why we like bonds right now, by the way. Julian, you have a question?
Yes, Michael, what's your argument for clients that don't want to own international after international has underperformed for the last decade?
That's one of the arguments to own international, is because it's underperformed. I mean, there's been an extended period, and these things generally go in cycles. If you look at the last 13 years, 9 or 10 out of the last 13 years, US stocks outperformed international. That just means they're increasingly undervalued versus US. By the way, if you look at the 12 years before the last 13. So over the last 25 years, the last 13 have been all US. The first 12 were all international. I can't tell you when that, the switch is going to flip and international is going to start to do better against US. By the way, it's the wrong question to ask. It doesn't matter that international equities don't, in a horse race, beat US equities to want to include them in the portfolio. Why is that? The answer is because they're not fully correlated, they're not perfectly correlated to US stocks. So they provide a diversification benefit. That is, by including international, as long as it's a positive return asset with less than perfect correlation, will improve the risk reward characteristics of your portfolio. This is hard to understand, but it is the absolute only measure that matters. If you're an institutional client and you're only taking compensated risk, only taking compensated risk means maximizing risk-adjusted return, not absolute return. And your risk-adjusted return is improved by including international equities. By the way, just to put a fine point on this slide, international equities are almost 2 standard deviations cheap to US stocks right now. This is the period of the last 10 years when you had US stocks outperforming international. International underperforming just means they got cheaper on a relative basis. Right now, they're historically cheap. And one of the tailwinds that you want for international equities is a depreciating US dollar. If you own international equities unhedged, which is the way we invest in them, you get a benefit in terms of return enhancement from a depreciating US dollar. That's because the currencies you're invested in are appreciating, and that helps your total return. So the US dollar is supposed to go down 3% between now and the end of the third quarter of this year. And here's the expected change. This is what the currency markets are telling us right now. The Japanese yen should depreciate against the US dollar by 7%. Should appreciate against the US dollar. This is in US dollar terms. The US dollar will depreciate against Japanese yen by 7. So British pound, Canadian dollar, Aussie dollar, New Zealand dollar, euro. Overall, versus our weighted average versus our trading partners, you should get a 3% boost from international. That's the expectation. Julian.
Yeah, Michael, so we cover the international against US. Now can we discuss where to position in a cap structure, large cap, mid cap, small cap, and also thinking about how should we think about active or passive, when it's so hard to pick stocks and pick the winners?
Well, so with 6 minutes left in the call, it's a lot to cover, but I'll say this. You should lean towards active management in inefficient markets when volatility is high. You should lean towards passive management in the efficient markets, the more efficient markets. US large cap is a very efficient market. US large cap growth has been almost impossible to outperform in the last 3, 5, and 10 years. So you should consider passively investing and reducing your overall portfolio expenses by investing in the most efficient markets, which includes US large cap. The least efficient markets include international equities and bonds. And the least efficient markets are private markets. So alternatives are an excellent allocation booster. So bottom line is bonds should be actively managed. International equities should be actively managed. Maybe small and mid cap should be actively managed. This is generally speaking, by the way. Generally speaking, you should probably consider passively managing a lot or all of your US large cap, which is different than the past. In the past, that's where most people took their active exposures. So you may or may not be able to make a switch if you're subject to taxes. But the idea that you'd want to try to get there over time seems to make sense to me. What was the other question, Julian?
Well, there's 2 more questions I'd like to ask, and we only have a few minutes left, but I guess the first one is on commercial real estate. It's quite a lot of risk out there, and what's your view on that?
Commercial real estate has taken a pretty significant hit because of work from home. Question is, what's going to happen to all those empty office buildings? And over time, they're going to be repurposed. And again, Julian, we had this conversation, along with Derek Newcomer, our head of alternatives, who's covering a lot of our real estate investments. A lot of the real estate might turn into, the analogy might be malls from 10 or 15 years ago. shopping malls were going the way of the dinosaur, but they're still around because they've repurposed the space. So you may see some office space get repurposed into residential or multifamily or whatever. It's bad for sure, because the cost of funding for commercial real estate is increasing. And once they have to refinance, if the Fed hasn't lowered interest rates by the time they have to refinance, and some buildings are going to go bankrupt. Is it going to be a disaster like 1993 or 2008? It's hard to tell, but probably not. The U.S. economy is very flexible, very, very responsive. By the way, you did ask about cap structure and value versus growth. And I'll just highlight again things we've talked about for the last year and a half. We still like value over growth. We still like non-U.S. over U.S. And we're underweight. We're neutral weight small caps, and we're a little overweight mid caps. So I mean, not a lot of risk taking in the equity portfolio. Nudging it around, call it enhanced rebalancing to reflect what's happening in the market, and not taking a lot of risk because we're in the late cycle. Next question.
Yeah, I want to ask that question. It's probably going to be the last one, because I think it's at the core of what we do, which is, can you define compensated risk? What do we mean?
Compensated risk taking is the essential ingredient to an institutional investment process. I mean, you can measure compensation for risk taking. I'll give the example of corporate bonds or high yield bonds. Do you want to invest in high yield municipal bonds today? Well, tell me what the compensation for default risk is, and that is measurable. The compensation for default risk in a high yield bond is the spread, the yield minus the treasury yield. So whatever the yield on that bond is, if you're getting 9% on a high yield bond and the comparable treasury is a 5% or a 4% yield, what did I say, 9% and 4%? That's a 5% or 500 basis points of spread. Historically, that's good compensation for risk taking. That is, it will pay you enough for default risk that you should invest in high yield bonds. If that number, if it was 7.5% and the treasury yield was 4%, that's only 350 basis points. That's about average or less than average compensation for risk taking for corporate bonds, for high yield corporate bonds. So every single asset class has a compensation for risk taking. Your institutional investment team at Beacon Point will measure that. And that's why we can tilt in and out of these portfolios. Value looks really cheap from a compensation perspective versus growth. Growth does not seem to offer a lot of compensation. It's not perfect. I mean, clearly it would have been better to be in more growth and value in the last 12 months. But I'll admit to being blindsided by the AI thing. Didn't know it was coming. I don't know who did, but that's another thing. We are not void of growth. Even if we like value over growth, it's a 3% overweight or a 3% underweight. It's not, you're not zeroing out the growth from the portfolio. It just doesn't work that way. By the way, last point here on the bonds. Compensation for risk taking in bonds is measured by yield. So the yield on the Lehman Ag right now is close to 4.9%, which tells you for the next, this is historical yields and then the subsequent 5-year returns. Your returns on bonds can be predicted with a high degree of accuracy, especially core bonds or core municipals, by their current yield. So right now, the forward projection for bonds suggests they could yield 5%. And again, the other compensation, I'll use, since we're here and talking about compensation, the compensation for bonds is not just spreads, but if it's a treasury bond, what's the real yield? What's the inflation adjusted yield? There's compensation for, you're being compensated for taking risk in treasury bonds because the real yield is very high. Whereas going back to 2019 to 2021, there was no value in bonds because the compensation, it was a negative real yield. So that's really kind of it. What other questions do we have to wrap up today, Julian?
I guess there's one more that I'd like to ask you, which should take you 30 seconds to answer, which is about what percentage of the portfolio we recommend investing in alternatives?
The answer to that question is it depends entirely on your appetite and utility for liquidity, because you are going to get paid a lot more. By the way, alternatives are not different risk factors than you're already being exposed to in most of the public markets. Public equities are what trades, daily traded, buy them on the New York Stock Exchange, NASDAQ, whatever. Private equity isn't daily traded. Public real estate investment trust, private real estate, publicly traded bank loans or corporate bonds, private credit. I mean, they're the same risk factors that you're exposing yourself to or should be exposed to on the public side, but the vehicle that you're invested in restricts the liquidity that you have access to. And here's the thing about why you get paid a lot to give up that liquidity, because most people don't want to, but they could, they just don't know why they would. And the answer is because you get paid a significant return premium, the liquidity risk premium and the liquidity return premium. It's hundreds of basis points in most alternatives. So if corporate bonds are yielding 5 or 6, you can get 8 or 9 in private credit because of the liquidity risk premium. It's as simple as that. So if you're willing to give up liquidity, these markets are a little more complex. So there's an informational asymmetry risk premium too. There's 2 or 3 risk premiums that are available in alternatives. So you have to decide how much liquidity you want to give up. And the answer for most of our clients is about 20%. For a lot of institutional clients, it's 30 to 40% because they have a longer term investment horizon. So alts, I mean, pick a round number, 20 to 25% for most private clients is probably appropriate.
Michael, we're 3 minutes past the 1.5 hour mark. Do you want to keep trying to answer questions, or shall we wrap it up?
I think we wrap it up and try to respond offline. Our marketing team will be able to scrape the Q&A, and we'll get back to the folks if there's a contact data there. Sorry if we didn't get to all of them, but I'll just say, thanks everybody for joining. Really appreciate you guys taking 90 minutes of your day to listen to us talk about macro and markets, and we'll be back again in May with another edition. Julian, any final comments from you?
Yes, thank you, Michael, and everyone. Please look out for our invitation in your email inboxes for our next quarterly macro and market update. We already have the date, so that will be on May the 16th, which is a Thursday at the same time. So see you all next time. À bientôt.
Bye now. Thanks.